Plug Power is currently trading at $3.24 per share, marking a significant intraday jump of 1.89% as of Friday afternoon, April 24, 2026. While the broader market remains fixated on the usual tech giants, Plug Power has quietly started to detach itself from the purely speculative bucket it has lived in for years. Most investors looking at the screen right now see a stock that is still a fraction of its former glory, but the reality is that we are witnessing a fundamental shift in the company's internal mechanics that the market has not fully priced in yet. The expectation has always been that Plug Power is a someday company, a business that talks about the future of hydrogen while burning through cash in the present. However, the hidden reality is that the new leadership under José Luis Crespo has moved the goalposts from expansion at all costs to a ruthless focus on margin health. If you look at the recent $132.5 million deal with Stream Data Centers, it becomes clear that this is no longer just a fuel cell play for forklifts. It is an infrastructure optimization play that positions the company as a backbone for the power-hungry AI data center market. The market sentiment around Plug Power stock is often a tug-of-war between high-conviction believers and skeptics who have been burned by past dilution. Right now, the intraday volume is showing a distinct pattern of institutional accumulation rather than just retail frenzy. This is likely a reaction to the 275-megawatt electrolyzer contract in Quebec, which represents one of the largest single awards in the industry's history. Most people think of hydrogen as a niche alternative, but for large-scale industrial projects like the Courant ammonia project, it is becoming a necessity for decarbonization. This tension between the hype and the hard engineering is where the current volatility comes from. If you are using a Fidelity trading platform or checking your Robinhood app today, you'll notice that while the price is up, the resistance at the $3.50 level is heavy. This is the reality of a stock that is trying to prove it can actually generate a positive gross margin. Last year's fourth quarter was a watershed moment because it was the first time they actually reported a positive gross profit, even if it was a modest $5.5 million. It's a small number, but for a company that has historically bled cash on every unit sold, it's a signal that the efficiency measures under Project Quantum Leap are finally taking hold. When we talk about online investing and navigating these types of growth stocks, the biggest risk is always the gap between the narrative and the net income. Plug Power has been very vocal about reaching positive adjusted EBITDA by the fourth quarter of 2026. That is a massive mountain to climb. The current daily swings reflect a market that is trying to decide if management can actually execute without coming back to the well for more capital. We've seen this story before with other high-growth sectors. Think about how Nvidia stock or Apple stock performed during their early transitional phases. There were years of sideways movement where the market demanded proof of a sustainable business model. For Plug Power, that proof is starting to show up in their asset monetization strategy. By selling off non-core assets and focusing on high-margin electrolyzer sales, they are trying to bridge the liquidity gap without further diluting shareholders. This is exactly why specialized tools like Schwab Intelligent Portfolios or various robo-advisors often classify this as a high-volatility asset. It isn't for the faint of heart, but the institutional activity we are seeing today suggests that some big players are betting on the turnaround being real this time. Looking at the broader landscape of investment help and the tools available to the modern trader, it is easy to get lost in the noise of daily fluctuations. If you look at your Fidelity brokerage account or your SoFi active investing dashboard, you might see a sea of green today, but you have to ask yourself why the needle is moving. It's not just a sector lift. We are seeing a divergence where Plug Power is outperforming some of its peers in the renewable space. This is partly due to the fact that they have a global footprint that others lack. Shipped capacity has now crossed 300 megawatts across 6 continents. This isn't a lab experiment anymore. It is an industrial-scale operation. However, the bearish take is that the company still has a massive operating expense profile. Those who use interactive brokers trading platforms to short the stock are betting on the idea that the hydrogen economy is still too far away to justify the current burn rate. The reality is likely somewhere in the middle. The company is getting more efficient, but the macro environment, specifically high interest rates, makes it expensive to fund these multi-year infrastructure bills. I want to pause here for a second and get your take on the current state of the hydrogen market. Comment below how many shares of Plug Power you currently hold, or if you've moved your capital into more stable plays like Fidelity ETFs lately. It's always interesting to see where the community is leaning when a stock like this starts to make a run. The business model itself has undergone a significant transformation. In the past, Plug was almost exclusively a material handling company, providing fuel cells for companies like Amazon and Walmart. While that remains a core part of the business, the Gen Eco electrolyzer segment is where the real growth is happening. This segment generated nearly $190 million in revenue last year and has an $8 billion sales funnel. That is a staggering number for a company with a market cap at these levels. The expectation is that this funnel will eventually convert into high-margin service contracts. The reality, however, is that conversion takes time, and the time is what the market is currently pricing. Every
time they announce a new non-deal roadshow or a Reddit AMA with the CEO, they are trying to manage these expectations. They are trying to convince the market that the liquidity they've secured, including the $368 million in unrestricted cash, is enough to get them to the finish line of profitability by 2028. If you are engaged in self-investing through platforms like Robinhood stock trading or SoFi investing, you have to be aware of the dilution ghost. This is the fear that even if the company succeeds, the value per share will be capped because they keep issuing more stock to stay alive. In 2025, they did exactly that, and it's why the stock is still under $5 despite having revenue records. But the shift in 2026 towards asset sales rather than stock issuance is a strategic pivot that shouldn't be ignored. It shows a management team that is finally listening to shareholder concerns about equity value. When you look at your Fidelity Wealth Management reports or your individual brokerage statements, you want to see that kind of discipline. It is the difference between a company that just wants to survive and one that wants to reward its owners. Let's look at the future outlook and the catalysts that could actually drive this stock back into the double digits. The biggest one is the Department of Energy loan guarantee. There has been persistent talk about a multi-billion-dollar credit facility that would basically eliminate the liquidity risk overnight. If that happens, the expectation of a cash crunch evaporates, and the reality of their massive sales funnel becomes the primary driver of the stock. On the flip side, the risk is a delay in the green hydrogen tax credits. If the government doesn't provide the expected clarity on these subsidies, the economics of green hydrogen projects become much murkier. This is why many investors hedge their bets with more diversified options like Fidelity Mutual Funds or the SoFi Robo-Advisor, which spread the risk across the entire energy sector rather than betting on a single horse. The contrast between the market's expectation of failure and the reality of Plug's operational progress is the most compelling part of this story. We see the same thing in other high-growth sectors. People often look at the Robinhood crypto section or the latest tech trends and forget that industrial revolutions take decades, not months. Plug Power is trying to build a new energy vertical from scratch. They are producing 25 tons of liquid hydrogen a day and have a logistics fleet that rivals some mid-sized gas companies. That is a physical reality that contradicts the "it's just a meme stock" narrative. Whether you are using the Fidelity mobile app to check your positions or deep diving into interactive brokers' fees to optimize your trades, the data points to a company that is slowly but surely professionalizing. To summarize the situation, Plug Power is currently sitting in a state of high-tension equilibrium. The live price of $3.24 reflects a cautious optimism that the new CEO can deliver on the promise of margin expansion. The expectations are low because of years of missed targets, but the reality of their massive project wins and improved gross margins suggests that a turnaround is underway. The stock is a classic battleground between those who see a future leader in the hydrogen space and those who see a cautionary tale of overexpansion. As we move through 2026, the key metrics to watch won't just be revenue growth. They will be the net loss narrowing and the successful monetization of assets. If they can hit that positive EBITDA target by the end of the year, the conversation around this stock will change completely. It will move from a speculative online investing play to a legitimate industrial powerhouse. For now, it remains a high-conviction, high-volatility name that requires constant monitoring, whether you're using a Robinhood investments account or a sophisticated Fidelity IRA setup. The reality is catching up to the narrative, and for the first time in a long time, the numbers are starting to tell a story of sustainability. Keep a close eye on the volume and the upcoming earnings calls. They will be the ultimate test of whether this reality can finally exceed the market's long-standing skepticism. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk.